So recording will be available once we end the webinar. And this is a basic because I do not know your actual knowledge about the financial calculation that you have studied. What are the your current level of knowledge? So I'll go with the basics of the formula. Then in the couple of days, I'll go with the advanced formulas which we can use and we can learn in the NISM certification. Hope it will help everyone. So let me share my screen. Right. So you're able to see my screen. Uh, Good evening, everyone, and welcome again to give your valuable time for this initiative from our side. I'm Devendra Negi, founder of BFSI Courses Academy. It is a learning platform for all the individuals, students, professionals to get the complete information related to the BFSI certifications, especially for the NISM. So, how did I start this journey? I was teaching to the university students in the bachelor program, and they find it very difficult to prepare for their certification examination, and they're not able to get up to date information related to the NISM study material. I also found very difficulty in getting all the study material online, though some of the websites were providing the study materials, but they are not up to date. They are providing old dated information. So I thought that it will be very helpful for others to have the up-to-date information related to the NISM's study materials. Then I started with the mock test for my students, and that will help others also. My students were able to crack uh, 5 to 6 certification in their graduation program. Before completing their graduation degree, they were able to complete at least 5 to 6 NISM certifications. The first one with the basic, we start with the basic 5B, then 5A, then securities market foundation, then securities operation risk management, then equity derivatives, then merchant banking, and others also. So it's their journey, and I hope that you will be also finding the material useful on our platform, and I provide the up to date content and hope to start with the recorded sessions, which will help for those students, those learners, those who has difficulty in getting those material. So I'll be uploading the material in both Hindi and English in the video format. So there are certain participants who do not want the Hindi videos, so we'll be adding the English videos. Also, I'll be translating the NISM equity derivative in the Hindi version. So there are certain learners who want equity derivative material in the Hindi language. It will help the audiences to learn it in Hindi. Though there are websites which provides equity derivative material in Hindi, like Zerodha, Varsity, and other platforms. So let's start with today's sessions. If anyone has any questions, then they can put it in the chat box. I'll review it later. And if you're not able to hear me properly, then you need to reconnect, rejoin. So the basic formula that we use in the which is also called the time value of money. So this formula is very important for the finance professionals. If we understand it properly, it will benefit very well. It though this formula has been misused by many of the finance companies. The misuse part, I'm not going to discuss. You need to find out how. In the finance world, we all only see the return in a different way. So whenever we present any uh, future amount or any cost which can be increased, we use this formula, which is very very simple. It has been studied while we were in schools. So it is generally start with the amount that we, with the principal that we have put in, and the rate of interest and the number of years it has been put in. So this gives the future value of the amount. So we call it compounding. So it can happen for a 1 year, 2 years, 3 years, and so on. But when we calculate as a discounting, what we do, so discounting gives the present value of any future cost or anything that is currently valued. We can calculate its value, uh, maybe uh, 20 years back, 10 years back, or 5 years back. So you can see what are the things that you need to know. Uh, any of the variables, one thing is missing, you can calculate. So if amount has been given, the future value has been given, the present value has been given, and you know the number of years, you can calculate the return. The return part is used in mutual fund as a CAGR. So if you see the CAGR of 1 year, 2 years, 3 years, 5 years, it is being calculated using this formula. So it's very simple. Maybe used written in a different way. Let me erase. So let okay, just a minute. So this way you can also write it down if you want to know the return value. It is end value, begin value. So there are different ways things has been written over internet, over books, and sometimes we are not able to. Suppose if you do not know how to calculate the return, if you know this formula, you can get this formula. How? If amount, you, the principal will be going at the denominator, right? And 1 plus r to the power n. And when you give the power to on the another side, it will be 1 by n. And this 1 goes to here. It is a divided by p, 1 to the power n minus 1. So simply the this formula is very easy, although we know is very well, and sometimes we forget it, then and we confused with using this CAGR formula. So CAGR is compounded annual growth rate. It is used to calculate the investments. So if someone has invested in real estate, gold, or in a portfolio or a stock, then we need to calculate it. But if there are different cash flows, different types, there will be different cash flows, then we are not going to use this R. Then we use the XIRR. So it is an extended internal rate of return which is used in Excel to calculate the multiple cash flows. The cash flows can be in the form of investments or in the form of dividend or in the form of redemption, right? So simple formula future value, which is also used in time value of money in different study materials. So you'll be finding this formula in a number of ways. Anyone has any questions, they can put it. I'll answer it later. right? So let's go to the next slide. So we are currently discussing the formulas which is used in the mutual fund space. So in 5A examination, so if you want to calculate the cost, the future cost of anything, then we need to use this formula. So future cost can be the education cost of a daughter or a son, or higher education, cost of medical expenses, anything that is being used for financial goals. Then we use this formula, right? Now comes to the next one is the trail commission. So commission is paid in mutual funds on a trail basis. So trailing means no upfront commission has been paid. So suppose if someone has invested 1 lakh rupees, if you're investor, if you're a mutual fund distributor, MFD, and you have invested your client's money on 1st of September 2024. So during how many days? Suppose the value of the NAV will be calculated later, right? So till tomorrow, already the NAV has been calculated on a business day. So based on the NAV, we calculate the assets under management, which is the AUM. So whatever assets that you manage, so it will be calculated by the RTA, the registrar and transfer agents, which is CAMS and K FinTech. They calculate the uh, advisors or the distributors commission based on the number of schemes the client's money has been invested. So giving us simple calculations just for your reference, if you have invested only 1 lakh rupees, your client's member, the money has been deposited, whatever NAV. So suppose the NAV is rupees 10 and it has been changed to rupees 10.5. So every day, if I think that there is no change in the NAV, I'll be calculating the trail commission for that. So in examination, the question may be asked that the client money is invested for 20 days. Because the client has invested on 10th of September, you need to calculate the 20 days commission, which is being paid to you. And there is no change in the NAV. So NAVs remain constant for each day. So for from 11th September till 30th September, you will be using this formula. Your AUM does not change because the NAV has not been changed. So it will remain 1 lakh multiplied by the trail commission rate, which I assume that 1% in the regular plan. It may be higher depending on the advisor terms with the assets under management, AMC. 1 lakh with a trail commission of 1% divided by 365 days. This will be your trail commission for each day. And you multiply by 20, you'll get 20 days commission. It's simple. I can use the Excel to show that. So you need to know how much amount, if you are going to become a distributor, you need to know the amount of earning that you'll be getting. So day one, day two, till how many days? But we are thinking that the NAVs does not change. So our calculation will become easier. How? So rupees 1 lakh multiply by 1% divided by 365. The 2 rupees is a single day. You multiply by 20. So 54 rupees is your earning. So 54 rupees is the earning for my 1 lakh of client investments. So you can see if your AUM grows, your earning also grows. So if suppose that is if you have invested 1 crore, that is 10 lakh, 1 crore. So your earning will be 5,000. So if you're managing 10 crore, it will be higher. If you're managing 100 crore, it will be much higher. So as clients assets grows, your income also grows. So just for the example purpose, that it may be asked in the examination how the trail commission is calculated if you are a mutual fund distributor. NAV calculation. So how the NAV is calculated? Let me check whether I have okay, recording is on. NAV calculation. So in NAV calculation, every day the uh, whatever interest income has been arrived, if the bond is in the portfolio or any dividend income arrived from the equity portfolio, any realized capital gain, if the any redemption or the fund manager has withdrawn it, so realized capital, there may be valuation gain which is used to be as a notional gain, but in an ISM certification it is used as a valuation gains. Then realized capital losses. So there may be instances when an fund manager has sold the investment at a lower price, which has been bought at a higher price. And valuation losses also due to the market uh, went down. The fund managers who is managing the assets, their equity portfolio goes down. There will be valuation losses also, and scheme expenses, scheme running expenses, which we call the expense charges. So there are different heads the scheme has expenses. So for the example point of view, uh, if the value of the stock is 150 crores, value of the bond is 67 crores, and value of the money market instrument is 2.3 crores, dividend accrued but not received. So it means that the dividend has not been paid yet, so it will be included on the NAV calculation. So if any company has declared a dividend and the record date has been passed, but it has been accrued, it has not been paid, and interest also, interest accrued but not received, it will be added. Fees payable, it will be deducted from the NAV calculation and divided by the number of outstanding units. So you add 150 plus 67, then add 2.36, dividend 1.096 plus 2.68 minus 0.36 divided by 1.90. Because all the values are in crore, so we can write their initial numbers and we can divide it with the number of outstanding units. So suppose in examination what is being asked, let me give you an example. So what they do in an ASM's real examination, they write their values in lakhs. So it may be written as 109 lakhs, not in crore. So if you add 109 in that, the NAV value will be different, right? So keep it in mind that whenever if you're taking the NISM examination of NAV calculations, then they check the units. If the units are in same value, then you can add and divide. If the units is in different, so lakhs and crores or thousands, then you need to come in the same units. That will help you for your correct NAV calculation. I hope it will help you to understand this formula for NAV calculation. The most important formula, which is for portfolio management or any scheme, so for PMS or mutual fund, so any portfolio will have to be checked whether it has been given a better return with respect to the risk. So if there are two schemes, A or B, has generated a return of 12% per annum, both has been given a return of 12% per annum. So based on which formula that I'll be using that in order to know that which fund I should choose. If you are a advisor or a mutual fund distributor, then your client is going to ask you that please tell me which fund should I choose you. Now the Sharpe ratio will help you to understand. You need to find the scheme's standard deviation. Scheme standard deviation is available on uh, the respective uh, fund fact sheet as well. So how this formula works? So Sharpe ratio is scheme return minus return of the risk free divided by the standard deviation. And how I remember this formula is very simple. S, then denominator will come standard deviation. Is simple as that in order to remember it. So risk free return is a treasurable rate. So there is an example that is a risk-free rate is 5% and standard deviation is 0.5%, and the scheme has given a return of 7%. What will be the Sharpe? The Sharpe ratio is can be on the uh, debt fund also, because debt fund is also minor standard deviation, then it can be also be used. But in debt funds other parameter is used. Generally it is being used for the equity has a higher risk, so we need to know that how the risk adjusted return is going to be. So Sharpe ratio is 7 minus 5 and 0.5, which comes to 4. So if scheme A is 4 and scheme B is 5, so which one we should choose? Is it scheme A or scheme B? So scheme B has a higher Sharpe ratio. It means the denominator is less, the standard deviation is less. That's why it's giving the higher value. So scheme B is better than the scheme A. With respect to the same return, it is giving us a higher Sharpe. It means that the scheme B is less risky. That's why I'm choosing scheme B, or I'm advising my investors to be on scheme B for a less risk in their portfolio. Trainer ratio is also important because ratio uses the beta. So what does beta mean? So you have heard this term before. So there are two risks: systematic risk, unsystematic risk. So systematic risk, which is in the system, which is called market risk also, is denoted by the beta of any stock, beta of a portfolio. Then this is market risk. Unsystematic risk can be diversified to different or maybe through different creating a set of portfolio. It reduces the risk, but systematic risk cannot be reduced. It can be reduced through different things, like taking a futures positions, hedging the portfolio. That's why derivatives gives the reducing the systematic risk, because derivative uh, futures will have that option when a fund manager buy the futures in order to hedge and use that thing in order to reduce the systematic risk. Unsystematic risk can be reduced through diversifications. So this is same formula, RS minus RF. It is called risk premium. So whenever someone is asking for risk premium, then a return of the scheme minus with the risk-free rate is called the risk premium divided by beta. So beta of scheme or mutual fund scheme. So if 5% is a risk-free, beta is 1.2, 8% is the return that we have got. So 8 minus 5, then 1.2. It gives 2.5. So higher is the trainer, then better is the fund. So higher trainer means the beta value will be less. So what is the beta of 1.2 means? If the market goes up by 20%, your fund will give 24% return. If the market goes down by 20% down, negative return, your portfolio will be down by 24%. And beta of any index funds will be 1. Anyone has any questions? All the participants who have joined, any questions you have? Okay. Now, this is in an ISM 5A, it does not have many calculations because it's a basic certification for to become a mutual fund distributors. So higher calculations will be given on the research analyst, investment advisor level 1, level 2, then portfolio managers, PMS distributors. Right? They have the calculations, they have the case studies. There may be calculation on retirement advisor also, but not in mutual fund 5A. So mutual fund 5A deals with the basic. There is one formula which may be used as a real rate of return, which I'll be discussing it later. So you will see that. So equity derivative, the first formula is being used is impact cost. So impact cost, how it has been calculated, you have seen the screenshot of any whenever you say any stock, it gives the value of impact cost also. Impact cost, how it has been calculated. So what NSE does, exchange does, they check the best buy and best sell on the quotation, on the best price that has been quoted. On that they gives the ideal price. What is the ideal price that an investor in order to buy that stock? So if the best buy is 90 and the best sell is 89, divided by 2 will gives the ideal price. And if you bought the actual price is 91, so if you bought it at 91 is the actual price, then the impact cost will be calculated on the 91 minus suppose is 89.5, then 89.5. So if higher the impact cost, it means there is a less liquidity because there will be a difference between the higher the buy and the best buy and the best sell. So higher is the liquidity, the impact cost will also be lower. So if you see the volume of the stock, if any stock which has a less volume, its impact cost also high. So based on the impact cost, there are different securities which has been qualified as liquid securities, illiquid securities. So illiquid securities comes with the calculation of the impact cost. So exchange calculates the impact cost every day. So in NISM equity derivative, this there is a in first unit, this being is discussed on the impact cost, and it has been discussed on different certification like securities operation risk management as well, because it is related to the exchange, and maybe this impact cost discussed on other derivative certifications. I hope this formula is easy to remember. The actual buy, so whatever your buy price or sell price with the ideal price divided by the ideal price. The ideal price can be calculated the average of the best buy, best sell. You don't have to calculate. The exchange calculates this information every day. There is a time period when it has been calculated as per the SEBI recommendations, SEBI guidelines. The exchange follows different things. It implements and they provide these information to the investors through their website as well. Futures contract pricing, how the future cost has been priced. So suppose on the once the contract ends, the new contract has been created on the exchange, the futures contract. Then what happens? Then the spot price, the current spot price, the rate of interest, it can be used for 3 months T-bills interest rate. Q is the expected return holding on the 3 month period, and T is the time for 3 months. Now we can calculate the what would be the future value as we have discussed in the first slide. This formula is being used in the futures pricing as well, which is cost to carry. So how these formula has been used in different ways, we need to remember it. And compounding has been given as uh, per annum compounding yearly, per annum compounding half-yearly, then per annum compounding quarterly, per annum compounding monthly, per annum compounding daily, then per annum compounding continuously. So compounding, how the interest has been compounded, the calculation is going to be changed. So in futures, value of the futures pricing is generally used as a continuous compounding. So uh, this is the only certification where we see this formula, and in continuous compounding we use the exponential. We use exponential in order to calculate the futures. We cannot use the same formula if you're using the continuous compounding here. So continuous compounding has been changed with the spot price e to the power. Now it goes to the power r minus q into t. So whatever value comes, it gives the futures pricing. And generally this formula is being used for futures pricing of that. After that, once the futures contract has been initiated, its pricing is based on the demand and supply. So it does not mean that every time we need to use this formula. Very important for equity derivatives, preparing for the equity derivative examination, that this formula is being used for that. And if there is no any expected return during that period, then this will be removed. So the formula will be futures price spot e to the power rt. The time can be for a 3 months contract will be 3 divided by 12 simply, because return is been denoted in a per annum basis, not monthly basis. So if it is monthly basis, then you don't have to divide, right? So if 6% per annum is the interest rate and 3 months contract and the spot price is 100, then you can write RT Let me show you in the Excel how the value comes. So suppose a stock values at spot at 1000 rupees. There is a 3 months contract. 3 months contract and the rate is 6% per annum. Now futures pricing is equal to spot price 1000 multiplied by EXP. Here in Excel, we use the formula EXP, then we use the rate 6%, we multiply by 3 divided by 12. 3 divided by 12. We close this formula. So 1015.11 is the futures pricing for the 3 months contract. Very simple. In examination, when it comes, you calculate. But suppose if you do not know if you do not remember the EXP formula in Excel, how you can calculate? The answer is simple. Then you need to use calculator, and in calculator also there is a function e there, e to the power. Then you can use that. But if you do not want to use the e in calculator as well, then you need to remember the value of e, which is 2.71828. So if you use this one and if you power it with the rate of interest and time of the expiry of the contract, then you get the value of the futures pricing. So different ways to remember. Maybe in examination, they ask the value of the exponential, they may be asked the formula, they may be asking the value of the futures contract based on the time to expiry of the contract. So very easy to remember it. Hedge ratio. As I talked about the systematic risk. So unsystematic risk can be hedged through diversification, but systematic risk cannot be hedged. So what fund manager does, they use a hedging ratio in order to hedge their portfolio. So if a fund manager is managing 100 crore and it has a beta of 1.1, then how much number of contract the fund manager has to use? So suppose a Nifty 50, what is the current value of Nifty 50? The 50 current value is 26,175. This is the spot of the Nifty 50. So suppose if futures contract is 26,500 and 25 is the uh, contract multiplier now. Earlier it was 50. So 26,500 into 25. So whatever value comes here, it gives the hedge ratio, that how many contracts the fund manager has to buy in order to hedge the entire portfolio to reduce the systematic risk from the portfolio. It will eliminate, it will become a zero risk portfolio. It becomes a zero risk by hedging, but this hedging with a cost. How the cost has arrived? The cost has been arrived by buying the the futures contract. So these futures contract will be bought by the fund manager. Uh, I don't know whether the fund managers do this, but they use a put option. They use a put option in order to hedge. So there are different funds which uses the put option. Put option is a better. It is low cost, give an option to exit, but futures contract have a obligation for the buyer and seller both side. But for a buyer of a put option does not have any obligation, right? They can exit, they pay a less premium. So it is useful for the fund managers to hedge their portfolio using put option rather than going with the futures contract. So this hedge ratio may be asked. It is generally asked, very very important in examination. It is asked in the examination that the number of contract or the hedge ratio that needs to be. Generally, this formula is value of the portfolio, beta of a portfolio divided by value of the index contract or beta of the index. Generally, beta of the index is 1. So it is not written here, but the actual, this is the complete formula for a hedging, because we are using the index. Index is always a beta 1. So there is no, but if we are using uh, another, suppose if you're using another thing which has a different beta, then we need to use a beta here as well. So do not assume that there is no beta of I of the index. It is not written over here because it is 1, it values 1, so it has been removed in the book as well. Basis, it has been asked in the examination, based on if the basis is negative, what does that mean? So if spot is higher, so suppose spot is currently as 1000, the future is 980, the basis is positive. So if it is, the spot is 980 and the future is 1000, basis is negative. So on what cases the basis is positive and negative, in examination it has been asked, and there are two condition which says contago and backwardation. Based on these two market condition, whether it is bullish or bearish, these thing has been arrived. So important formula for equity derivative for basis, two three situation has been arrived: positive, negative, contago and backwardation conditions. Option pricing. Generally, we do not calculate the option pricing, or do we? No. Option is priced already. So on the last Thursday of the month, when the option contract expires of the current month, then the new contract, how the new contract valued, the uh, the exchange calculate using this formula, which is called Black-Scholes. This is being used to calculate the European option. So in Indian market, all the option contracts are in European nature. The contract has been expired and the contract ends and the expiry. So how these values arrived? So there are different things which is used in the call option and put option. You can also create an Excel formula in Excel sheet. Using this formula, you can create an option pricing formula. In examination point of view, for the equity derivative and other certification, they do not generally ask to calculate that. But in advanced certifications, maybe in international certification, they may be asked for that, giving different values: the stock price, the strike price, when time to expiry, the risk-free rate, the volatility, which is standard deviation of the contract, natural logarithm, the normal distribution of curve, exponential function. All these values will be put in to calculate this. And this D1 and D2, we know that option Greeks. So option Greeks has been arrived using the Black-Scholes formula. So these option Greeks which is been used, it has been calculated. It is being changed. The option Greeks always changes based on the respective changes in the maybe in the option pricing interest rate. So anything it change, so option Greek's value also change. It is a sensitive. So they are very sensitive, similar to the stock of a beta. Give the sensitive with the stock. With respect to option pricing, option Greeks are very, very important. Now comes to the investment advisor. So as I told you in the beginning that I'll be discussing the basic part today. So maybe later we'll be discussing the advanced level of the formula. You will also practice those formulas which has been discussed today, and later you will also learn the advanced formula. So in investment advisory, uh, because as an investment advisor, they have to create the portfolio, they have to manage investments, they need to provide the recommendations, they need to review that, they need to analyze the client situation. So different things has been so they have a different level. So I think investment advisor level 1 and level 2 has the highest study content to be studied in the NISM certifications. So earlier it was short. So in 2021 they have revised that. 2021 they revised the syllabus. 2023 it has been changed certain things. Maybe this year they will be updated certain things on that. The same formula, time value of money, which we have discussed in the previous part. So now it has been written as a future value, PV, FV, and time value of money. This formula has been used in Excel. So Excel uses the PV formula to calculate the present value of an investment. The future value of the investments is used in the what are the things that you need to know? You need to know the rate. If rate is 12%, the number of years the investment has been done. So it may be for 5 years. PMT is a regular payment. So regular payment is generally called as an annuity. So and if annuity is investments like SIP, which is being paid on a regular basis, or maybe LIC policies, which is paid a premium on a yearly basis, maybe 10,000 per quarter, 10,000 per year, 15,000, 20,000. Future value means what is the future value which I'm going to calculate is present value. So if future value is 50 lakh, so in 5 years with a 12% of return, what is the current cost of that investment or the future value? How much should I invest today in order to get the 50 lakhs in 5 years with a 12% of annual return? With there is no any monthly any regular payment. If there is any regular payment on that, then it becomes an annuity as well, or the lump sum as well. So both investments can be done. So this is a simple formula, is an advanced. It is also future value as advanced also. So there is a type 1 and 0 used. So type 1 and 0 means if you do not have any PMT, whether it is if you type 0 or 1, 0 means begin or end 0, sorry, 1 means begin, 0 means end, then you will get the same value if there is no PMT, any regular payment. If it is any regular payment, then is the significance of using type 1 and type 0. Why? Because if you are investing today, then the value changes after 30 days, right? If you're investing at the end of the period, like so suppose if anyone is receiving any payment at the end of the month, then its value will be less, right? If anyone is receiving payment at the beginning of the month, generally all the payment now is being received at the beginning of the payment. Earlier, whenever a landlord is receiving a rent at the end of the month, then they can use, if they are putting that amount in an investment when the rent received, then they can use this formula as a zero, as a regular payment if it is being used. And CAGR, same formula that we have discussed, end value, begin value to the power 1 by n minus 1. It gives the same value. Real rate of return. This is also called as a inflation adjusted return. So how this formula is written, we call it triple R. In finance or in a CFP, it is called as a triple R, which comes 1 plus inflation, which is I, and 1 plus return, then minus 1 gives the rate of return. If suppose if someone earns a 10% of return and during that period the inflation is 5%, so generally what everyone says that 5% is the real return that you have got, but not actually. If it is an examination, it is being asked that what is the correct option, then you need to find it out. You need to put 1 plus I is 5%, then 1 plus R, sorry, it is 1 plus R is I. It is written incorrectly. It is 1 plus R, 1 plus I minus 1. Is my mistake. I've written it incorrectly. So it is 1 plus R is 10%, 1 plus 5% minus 1. Let me calculate in Excel to give you the. So if 10% is the nominal return on your investment, 5% is the inflation, then 1 plus R divided by 1 plus minus 1, and before that I need to bracket minus 1. So this is the actual return, which is 4.76 or 4.762 is the real rate of return. So 4.762 is the real rate of return, not the 5%. So in examination, 5% is also given, 4.762 also given, 4.5% also given. So you need to know the formula 1 plus I divided by 1 plus R minus, uh, in short form, it is also written R minus inflation divided by 1 plus I. In short. So in case of CFP calculation, they use R minus I, 1 plus I divided by, for the simplest calculation, because it gives the calculation easier. Annuities. You have heard the annuities term before. You know that annuities are being used for different things, regular payments. So PMT is the formula which is being used to calculate the loan value, because loan is paid at a regular interval of time. SIP, which is paid at a regular basis on a monthly basis. So that is also called the annuities. So annuities can be of end or begin. So ordinary annuity is the end. So if you pay a loan and someone asks you what kind of annuity is that, it is ordinary annuity. If you're paying a SIP, your investment, which you pay now, is annuity due. Which formula is used is the PMT in Excel. So what is PMT has been written? So you write PMT. What are the things that you need to write? The rate. The first is the interest rate that you need to know on the PMT. Then NPR, for how many uh, months, years that you're paying a loan or your monthly SIP. Then the present value. Have you put any initial amount? Like in case of SIP, if you do not invested any lump sum amount along with the SIP, then you write it zero. The future cost. So in case of loan, the future value always becomes zero because you paid the loan, then it becomes zero. The present value is the loan amount that you have got. And type 0 or 1. As I said, that ordinary annuity is uh, 0, it is end, and annuity due is with the begin. Uh, let's use two scenarios. I'll just give you an example. So you have a rate of 8%. You have taken a loan of 40 lakhs. The term of the loan is 15 years. I'm changing it to number of months. So 15 into 180. Then I need to calculate the EMI. So in Excel, we do not use any EMI formula. We use the PMT formula. The rate is 8% for a yearly basis. So we need to divide by 12. Why? In order to, because our EMI is stands equated monthly installments, means we are paying a monthly. That's why we need to divide the interest rate by 12. NPR becomes 180 because in 180 months, then my loan will be paid off. The present value, how much loan that I've taken, the loan amount will be taken on a positive. So this is a positive amount that I got a positive amount. The future value becomes zero, and then it is end or begin, it will be end. So use zero. It shows a negative amount. Why? Because that amount I need to pay. The bank will charge or the financial institution will charge me 38,226 if it is a fixed rate. Suppose if it is fixed for next 15 years, then this EMI will not going to change. If it is floating rate, so whenever RBI increases the rate, my EMI will be changed accordingly. If it is decreased, the EMI will be decreased. If I pay the same EMI, the term of the loan will change. Maybe if I do not want to change the EMI, if the borrower does not want to change the EMI who borrowed the amount, then the term of the term will reduce as the interest rate decrease. But if the interest rate has been increased by the RBI, in case of floating rate of interest rate, what a financial institution gives an option to the borrower: pay the higher amount in order to pay the same loan with this remaining tenure, or we will going to increase the tenure of the loan with the same amount of EMI. Two option has been given to the borrower. Right? Generally, borrower does not want to pay the higher amount because they have their mandatory expenses they need to do. So they go with the higher tenure if the interest rate in the market goes up. Now comes to the investment. How the investment goes. So suppose if I change it to 8% per annum, my investment, I am my future value of investment will become 40 lakh. The term of the investment is 15 years, and I'm investing in equity and expect a return of 12% per annum. Then my SIP, what should be I be investing so that I will achieve a 40 lakh in 15 years? So SIP will be calculated. Here is a catch. This investment is the rate of return that we have divided in case of loan by 12, but not in case of investment. Why? Because a loan interest rate is compounding monthly, and in case of investment, return that we get in the market is per annum basis. So we need to change this interest rate to nominal interest rate. Nominal 12%, then divided by 12. It is very, very important concepts while calculating the SIP. If you normally divide it by 12, your calculation will be wrong. And if you present this data to your investors, then they will give you a incorrect information. You're providing a incorrect information. The NPR is 180 days. The present value is zero because I'm not investing any lump sum amount. I'm investing what I expect a future value of my investment is 40 lakh, and I'm investing on a due basis at a beginning. My SIP amount will be 8,404. So if I invest regularly at 8404 for next 15 years, if I expect a CAGR of 12% per annum, my portfolio value will become 40 lakh. So for 15 years, for a child higher education or a foreign education based on that, or anything that can be for a child good, this can be used for that. So I think annuity part will be cleared here. Perpetual annuity. So perpetual means you'll be getting the same rate of interest, same cash flow throughout the year, like in case of perpetual bonds. So how much should I invest today so that if the rate of interest is suppose 7% and I'm getting a 10,000 per month, what should be my investments? So if a retiree says that I want 10,000 per annum per month every month, and I want to know how much should I invest, then perpetual annuity will be the best option, because in perpetual annuity, the invested amount is not going to be reduced. So here there is a example which is being used. So present value of the perpetual annuity, which is called PV, is the cash flow. The cash flow is maybe yearly basis, half yearly basis, quarterly basis, monthly basis, with the rate of return. So both should be in the same form. So if cash flow is yearly, your rate of return should be yearly. If cash flow is monthly, so if someone wants a cash flow of 10,000, then you cannot divide the 8% rate of return with, yeah, 0.08. You cannot write it down here, 0.08. You need to change 8% to a monthly basis. How? So you use a formula Excel, nominal, you 8%, then 12 divided by 12. L- Let me show you how the 8% per annum interest rate on a monthly basis. Nominal 8%, then 12 divided by 12. Let's change it to percentage term. Increase its number. So on a monthly basis, the rate of interest is 0.64. 0.64%. It should be in percent. If 10,000, so you can calculate if someone needs 10,000 per month every month, lifelong, perpetual, how much should that person invest? We can calculate that. 10,000 divided by the interest rate. Let me increase. Yes. So it is 15,54,235 rupees to be invested in such a bond, maybe a perpetual bonds, which gives an interest of 8% per annum. Then the monthly cash flow will be 10,000 per month. The 15 lakh value will not be changed. So it remains same unless and until the company does not bankrupt, or maybe uh, this perpetual bond issued by a government, but generally government is not going to introduce the perpetual bonds. So there are another annuities which is called growing annuities. Have you heard the SIP with a top up? SIP top up. So SIP top up has two options in a percentage term. So 10% increase yearly basis, or SIP top up with a fixed amount. So this SIP top up is 10% in a percentage term using a formula of growing annuity. So it is using end or begin. So how this comes? Your SIP is the first payment. SIP, whatever amount that you have invested, the rate of interest that you have got on of 12%, suppose if you expect 12% per annum, the growth that you expect. So if you're growing your annual SIP on a 5%, then the G will become 5%. If it is 10%, then it is become 10. Maybe it becomes 20%, then it becomes 20, which is called the growth rate. The number of periods. So number of period is, suppose if it is for 180 months, your rate of interest is going to be changed on the same way. So it is does not mean that if you write it down here, first payment is 5,000, then 1 plus R that you have written is 12%, then you cannot write 180 here. You need to change the interest rate also on the same value. So your N, G, R, or your P, if it is P on a yearly basis, then it is fine. If you are only invested one amount, suppose 10,000, and it is growing on a yearly basis, then it is fine to do not change other values. But if it is a monthly basis, then your first payment is a monthly basis, your rate of interest should be on monthly basis, your growth should be on monthly basis, your number of, as you have changed 15 years to 180, then it is fine. And if you use the growing annuity on a begin that you have invested your amount, then you multiply that with a 1 plus R. The R can be changed if it is on yearly. So from my side, this is the basic of the finance formula. There are other finance formula which is being used uh, in different advanced formulas, which, as I told, it can be discussed in the next sessions. I hope you find the session very helpful. If you do not find it, then you can give me any feedback that you have. I'm open to your questions if you want to write it down your question on the chat box. Any questions that you have? Do you have any questions? Thank you, sir. No questions. Thank you, Soham. I'll be sharing this PPT with you and to all the participants or those who have registered. The recording will be available. You will get the message. You can watch the recording anytime. The advance will be used on the next week. I'll be using the advance thing. And you can also join our live session also, which I'll be conducting from next month. It will give you an 80 hours of learning in the investment advisors and 30 hours in the mutual funds and 30 plus hours in the equity derivative. If any of one of you wants to know, you can also join the demo sessions that we have on the 4th and 5th of October. You can join the demo sessions. That will be helpful for you. And I'll be sending you the demo links as well. So because you want to. There are two types of learning. One is the learning that you do with the recorded videos. Another learning is the live session, which is a cohort based learning. It is being studied that cohort based learning is very, very useful for any learners. And another learning is a recorded, where you see the recorded sessions, you buy the recorded sessions and you do not watch it, right? I always prefer a cohort based learning. In my If I want to learn anything, suppose I learned Excel, I learned data analytics, I learned Python data science through a live session, not a recorded sessions. Though I've recorded all those sessions, but I do not want not watching it. And recorded live sessions, that you know what has happened on that. So we can end this session. You have given your valuable, precious time for a 1 hour, and